Hello, everybody, and welcome back. Today with me there is Luke Bars from Goldman Sachs Asset Management. Luke is a head of fundamental equity client portfolio management, and today we want to discuss recent development in Chinese A-shares market. Welcome, Luke.
Hi, Thomas. Thank you so much for having me.
Luke, how far is China's economy on the way back to normality?
The short answer, Thomas, is fairly long way into that process now. We're actually back in some areas of the economy to 100% of capacity or utilization, at least relative to the end of last year. I think maybe before we go into that in a bit more detail, it's worth just taking one step back and reminding people where we were even 3 or 4 months ago, because it has moved very quickly. And I think it's important just to reflect on that. What we saw in the first quarter in China was a significant collapse in growth, the biggest collapse in growth we've seen for over 30 or 40 years in China. And actually the delta on growth, just given we were running at about 6% annualized GDP in the fourth quarter of 2019, was bigger than we saw at the height of the global financial crisis. So this was a very deep shift in growth patterns within China. But the re-acceleration as we've moved out of lockdown, as we've started to see industries come back, has actually been pretty quick. And I think especially in secondary industries, so if you think of construction and manufacturing, you've actually seen a lot of those secondary industries go back close to 100% utilization in the last few weeks. Now, I think where we're still seeing a little bit more of a staggered recovery, or at least the pace of growth is a little bit more slowed, is in tertiary industries. So especially in the service economy and more consumer orientated areas of the market, that's still a little bit more sluggish. And that's somewhat understandable. I think we'll see parallels of that in Europe pretty soon. As we move out of lockdowns, you will see secondary industry start to pick up, but people's willingness to go to restaurants, to go to cinemas, to go back on holiday, it is naturally going to take a little bit more time than maybe we've seen thus far. But even in those areas, we're seeing growth somewhere back at the 70% level of where we were at the end of last year in certain segments of that services economy.
So what influence did the coronavirus pandemic have so far on the earning situation of Chinese shares and about their valuation?
It's a great question. Obviously, we're in the seat of being equity investors in the domestic Chinese A-share market. And so that's really what we have to care most about. And unsurprisingly, you saw pretty big revisions in earnings estimates downwards through the course of the first quarter, and many companies showed very significant collapses in growth. Now, I think what is interesting, and part of this is because China is first into this crisis and hence also likely first out of the crisis, is actually you're seeing some signal of upward revision starting to come through, or if nothing else, you're starting to see those Chinese companies domestically start to find a little bit more of a floor and show a path to growth through the course of this year. So it might not be that we have very strong growth for the aggregate of 2020, but it's possible that the Chinese domestic market can still show positive earnings growth over the course of this year, which is clearly in contrast to pretty much every other market we're looking at globally. Now, I think if you look at 2020 and 2021 in aggregate, that's where we start to see an even more positive picture. Because even though we've had this pullback in expectations and this downward revision in earnings for this year, the acceleration we'll likely see next year is pretty substantial. And actually, that's just one statistic I give you. It's more on the economic side of things again. But if you take the net impact of COVID on all of the economies we look at globally and think about the growth impact, so where would have these economies been at the end of 2021 versus where expectations now are, China is only going to miss that by about 1 or 1.5%. And that is very insignificant in the context of what we're seeing globally. We're looking at markets like maybe Russia or Brazil missing by something like 6 or 7% over that same period.
So which companies and industry will come out of the crisis even stronger in China?
In China, what we're seeing already is a big shift away from the old economy, the industrial sectors, the state-owned sectors, towards this new economy, where things like online activity, internet penetration, obviously the e-commerce story that's been very prevalent for a number of years, are starting to emerge, but also I think more of a high value add manufacturing economy. And in our opinion, a lot of those are going to be buoyed by what's happened through this coronavirus crisis, partly because it is a recognition from the Chinese government that they need to continue down that path of dependence on Western economies. In other words, they need to shift their economy to be more balanced and not be reliant on light manufacturing exports to the rest of the world to protect themselves from some of those demand shocks that they've clearly seen in the last few months. But also because you've just got this natural change in consumer behavior, where as much as we've seen e-commerce penetration accelerate in China over the last 10 years, and just for your context, Thomas, China is actually one of the leading markets globally in terms of e-commerce penetration. Coming into this crisis, it was sitting at around 30 or 35% of total retail, which compared to, say, Europe, which was around 15%, clearly at a much higher level. But even that is being accelerated because as much as that younger millennial generation are very familiar with using the internet, going online and shopping, what you've had through this lockdown period is forced adoption from older generations. So many of those internet and online platforms that have effectively been built for the Chinese ecosystem have continued to see acceleration and growth. And we'd expect a lot of that to be quite resilient going forwards. And I'd say one other area of the market that we've been very interested in for a long period of time, but I think again, could see some very positive acceleration post-COVID, is in the insurance space. You have seen the gradual recognition, I think, from Chinese consumers that insurance is part of their discretionary consumption basket. And whilst it might not be mandatory that governments put in requirement for people to have insurance, there is that possibility that there will be stricter regulation. The likelihood that people want to protect themselves to create some kind of safety net, I think, goes up even further.
So that's interesting. You mentioned e-commerce. I think everybody in the West is familiar with Tencent and Alibaba now. You mentioned the insurance industry. Are there further industries where we will see a big technological leap forward in the next year driven by the coronavirus pandemic?
There's a couple that I would think of, Thomas. Some that are similar to what we mentioned on e-commerce, being driven by the introduction of new users and our belief that those users won't necessarily go back to the way they were operating previously. And some less specific to the coronavirus crisis, more just the natural advancement in technology, but in some ways also accelerated due to the actions of governments and investors. So let's just look at those two examples. So I'd say on the first one, education is a very interesting sector in China. And investing in that space at this point is more in the offshore Chinese market than it is in the onshore market. But there are some very substantial, mature Chinese education businesses. And these are companies that are providing additional education services to children. And one of the things you've seen very clearly in China over the last 20 years is that, especially off the back of one-child policy, parents are very keen to ensure their children are educated to the best possible extent. And so paying for additional educational service is something they're very happy to do. Now, at the back end of last year, if we looked at some of those big educational providers, they would have run roughly 90% of their classes offline, i.e. you take your children into a classroom after school or on the weekend, and they get additional education. During the peak in the lockdown, by nature of people not being able to go to classrooms and there being sensitivity around putting people in small confined areas, 85% of that traffic moved online. Now, those companies were well set up to deliver an online curriculum. They'd already have all the online capabilities in place. It was just that for most people, the inertia of taking children into a classroom in the way they'd always done it had not necessarily needed to be broken. And what you saw in the height of the lockdown was actually people saying, well, I don't want to give up that opportunity for my child to be taught additional subjects. I want to make sure they have that opportunity, but I can't clearly take them into a classroom. Now, the big question here is, if at the height of the lockdown, 85% of those services were delivered online, does it stay at that level? I think it's very unlikely. We'll see some normalization over time. People will need to go back to using the offline course or the offline classroom. But I would speculate that a lot of people who previously hadn't utilized that platform or service will say, okay, actually, that's a very efficient way of delivering that solution to my child. So I think in that space, that's one area we are very excited about. I'd say the other, thinking more about implications of COVID, but coupling it with what we've seen over the last few years, is really in the healthcare space. And I'd say this is as much a global phenomenon, but what we're seeing at the moment in healthcare is really phenomenal. The ability to sequence the human genome, to create precision solutions to genetic diseases is fascinating. right? And just for context, if you think about the ability to sequence the human genome, we've only had that capability, at least from a technological standpoint, for the last 15 years or so. Right? The first human genome was sequenced in 2003. It cost about $2.5 billion to do it, and it took 15 years. As of today, you're at a point where you can sequence the human genome in roughly a week for under $1,000. And probably this year, we'll get to a point where we can do it in under 24 hours and for under $100. Now that opens up a huge amount of opportunity for companies that can then process that information and deliver much more precise solutions to individuals who suffer from some of these very challenging diseases. And the reason I mention this is because China has started to build its own healthcare ecosystem. So it will very likely go in a different path to, say, India. India has built a fantastic pharmaceuticals and generics business where it is the service provider for generics to a lot of your big Western healthcare or pharmaceutical companies. What China will likely do is continue to build a domestic healthcare industry that is specific to the needs of the Chinese economy. So delivering some of these more precise solutions, but in a way that can meet the price point you need within the Chinese economy, but also the needs of the broader Chinese government and population.
I think this was a great example about the genome, which shows the technological progress that we have made so far. On the other hand, we have seen this enormous volatility in capital markets in the first half year. So where do you currently find investment opportunities in China, and how do you navigate your Chinese equity portfolio through these volatile times?
It's an excellent question. And the Chinese market, along with all equity markets, have been fairly volatile. I'd say to a degree, the Chinese domestic market has been less volatile than many would have expected, in part because you had that underpinning of economic growth. And actually, China came out of the crisis arguably earlier than any other market. And the reason I say it's surprising in expectation is because don't forget that the Chinese domestic market is still 85% retail investors. And so the expectation would be that in times of crisis, you would see that panic trade and you would see markets become extremely volatile. And whilst that did happen to a degree, it wasn't anything different to what we saw in the rest of the world. And actually, in many cases, when we looked at the trading activity and we looked at the pricing we were seeing across the Chinese domestic market, companies were being traded logically or rationally. You weren't seeing indiscriminate selling in too many areas. Now, that said, when we think about investing in the Chinese domestic market, there's a couple of principles that are fairly critical for us. And I'd say most important within that is the idea of cash being king, right? In other words, you are a minority shareholder investing in the Chinese market. There are significant challenges here around government ownership. Roughly 50% of the Chinese domestic market is still majority owned by government. And it's not that every single one of those businesses is a bad business. There's some fantastic ones out there. But the challenge is you might not be the primary focus of management in terms of value delivery, right? In other words, there might be other agendas that that company is trying to solve for that mean that minority shareholders are not fully recognized. Now, the best way we can protect against that, as well as having people on the ground locally in China who understand these companies and invested in them for many years, is to understand what the cash flow picture looks like. And if there's evidence that companies can generate cash flow, that cash flow is feeding through to us as minority shareholders, that's the best way to protect yourself against not only short-term volatility, but a lot of those other more challenging corporate governance scandals that you have seen emerge, not least of which in the last few months in China as the tide has gone out and growth has started to slow. And the other point I'd make there, Thomas, and this is more of a structural point, is that we talked about the emergence of this new China economy, the emergence of the internet stories, the healthcare space, the shift towards insurance. A lot of these new China stories are still in the early stages of growth. So even though we may see some of these companies trade on slightly higher multiples, actually you take a long-term view, you think about the total addressable opportunity or total addressable market that these companies can service, it's really astronomical. And even in some of those big internet companies, when we look out over the next 5 or 10 years, we see significant upside to intrinsic value just by nature of how efficiently they've been run, the fact that they're not particularly capital intensive businesses, and hence again, coming back to that idea of cash flow, that there is a high degree of cash flow that's being translated through to us as a minority shareholder.
So we've seen this enormous bounce back and recovery of Chinese capital markets since March, and the recovery of Chinese economy. So looking forward, what are the biggest risks for the Chinese economy for now, for capital markets? And second part of the question, how about the trade conflict, which is developing in some kind of technological Cold War between the US and China now?
Yeah, look, it's an excellent question. And we have seen, not just in China, but everywhere, a really rapid acceleration, both in growth, but also equity markets globally. And I think for China specifically, it does reflect the fact that the economy is getting a little bit better. It has clearly meant that the entry point you're getting as an investor into the Chinese domestic market today is maybe not as attractive as it was 2 or 3 months ago. But I think it's important just to put that into context as well, Thomas. We're trading, roughly speaking, 5% above our long-term average in the domestic market on a price to earnings basis, and actually on a price to book basis, still in many areas of the market below that long-term average. So even though we've had that bounce back off the lows in the early part of the year, valuations still look fairly appealing. Now, it doesn't mean there aren't risks, and clearly the pace of growth is going to be a key driver over the near term. And intertwined with that is the fear of a second wave of cases emerging in China. I think the Chinese government have done a pretty good job of shutting down those sensitive areas if there are, or there's the perception that there are an emergence of new cases. But that's something we have to be thoughtful on. I would say, whilst it can be slightly draconian in some areas, that the reality is they have done a pretty good job of locking down at least the kind of inbound and outbound travel into China, out of China, to make sure that there isn't the same potential risk of re-escalation that we might have had if you just left that completely open. So I think that's one to be conscious of, and clearly that's a risk to all equity markets until we have either a very effective therapeutic or we have a vaccine. It's hard to say that won't be a risk to capital markets, though at this point we still think it's not something that should scare people away from equity markets, given we're still getting pretty interesting levels to enter into that. Longer term, there's clearly the US and China discussion that has to be recognized. There's two parts to it for us, or there's two sides to this for us. There's clearly a negative connotation for China, which is the world has recognized, not just with the US-China tensions from last year, the year before, but also from the coronavirus crisis, that they need to diversify their supply chains away from China. You can't be solely reliant on one country. It just creates too much of a risk within your supply chain. Now, that does create some issue for China, because there will be a shift of light manufacturing away from China. But actually, that's not inconsistent with what China is trying to achieve at the overall macro level. It wants to move up the value chain. It wants to turn its economy into more of a consumer-led and high value-add manufacturing-led economy. And I think actually, if anything, this will accelerate that process. And on the flip side, when I said that there's been a shift away from, or will be a shift away from China in the light manufacturing side of things, I think Chinese government has also recognized that they are very tied to the West in terms of the provision of very high tech components. So their dependence on Silicon Valley, on Europe, for some of those higher tech components actually is motivating them to build their own high tech industries domestically to, again, protect themselves from the vagaries of what happens globally. So again, it's a risk, and I think a re-escalation of US-China tensions, we clearly know we're running into an election year in the US, and that could be something that's on the agenda. But for us, it doesn't necessarily negate the long-term story here, which is incredibly attractive within the Chinese domestic market, and the potential for China to move towards a more sustainable, domestically led growth model, and the opportunities you can invest in that are directly aligned to that should hopefully over the next 3 to 5 years temper any short-term impact of that rhetoric being re-escalated.
So this was Luke Bars from Goldman Sachs Asset Management. Thank you very much for being with us today, Luke, and sharing your views with us.
Thank you, Thomas. Thank you so much for having me.